You ever look at a situation in the market and realize two completely opposite things seem to be true at the exact same time?
All the time.
Yeah.
It's actually one of the most confusing things for investors.
Right. Well, picture this. It's April 13th, 2026. We are looking at Energy Transfer LP, ticker symbol ET. The stock is currently sitting at $18.85.
Hmm.
And over the last 10 days, I mean, it has just been bleeding out, dropping over 4.17%. The technical trend is pointing down, and, short-term sell signals are just flashing everywhere.
Yeah, the charts look rough right now.
They really do. But then, if you look across Wall Street, you've got this whole chorus of analysts basically screaming that this is a strong buy. Like, they're calling this asset wildly undervalued, practically begging people to pay attention.
The massive contradiction.
Exactly. So I have to ask you, listening to this, which is it? Are you staring at a falling knife, or, are you looking at the discount of the year?
And that contradiction is exactly what makes this specific moment in the market so compelling. You got immediate, visible pain on the charts that is just completely at odds with this intense long-term institutional optimism.
Yeah. And that is our mission for today's deep dive. We're going to rip open the ledger on Energy Transfer. We'll unpack their massive financial engine, decode the actual technical order flow to figure out who is doing the selling, and settle this intense debate over whether this stock is a hidden infrastructure gem or just a classic retail yield trap.
Right. But before we get into the heavy machinery of their balance sheet, just a quick reminder for everyone. This deep dive is purely an analysis of the data, the financial reports, and the technical sources provided.
Yep.
We're just synthesizing this information to help you understand the landscape. This is not financial advice.
Absolutely. Oh, and real quick, if you want us to keep making these deep dives, please hit that like button, subscribe to the YouTube channel, and leave your compulsory feedback in the comments. We got to feed that algorithm.
Definitely. It helps a lot.
Okay, let's unpack this. Because you really can't understand a recent price drop without, first looking under the hood at the company's financial engine. Are we looking at a serious structural leak, or is this just normal wear and tear?
To answer that, I mean, you really have to grasp the physical reality of what Energy Transfer actually is. At an $18.85 share price, we are talking about a market capitalization of roughly $66 billion.
Huge.
Massive. And over the past 52 weeks, it's traded in a fairly tight range, as high as $19.86 and as low as $15.80.
Okay.
But the valuation is really just the starting point here. When you look at their full year 2025 income statement, they pulled in $85.54 billion in revenue.
Wait, $85 billion? That is just an astronomical amount of money moving through the system.
It is. I mean, they are physically moving a massive volume of the country's baseline energy. And from that revenue, their adjusted EBITDA, which is basically the raw operating cash generated before taxes, interest, and all that, hit a record $16.0 billion.
Wow.
Yeah, that's up 3% year over year. And if you look at their net income for the first quarter of 2025, it came in at $1.32 billion. Up from the previous year.
Okay, so on paper, that sounds like an absolute cash printing machine.
Mm-hmm.
So where's the disconnect? Because clearly the market is punishing them for something right now.
Right. So the primary stumbling block really stems from their fourth quarter of 2025. Their earnings per share came in at 25 cents.
Okay.
While Wall Street was actually modeling for 36 cents.
Well, that's a pretty significant miss. But I got to pause you here because looking at the balance sheet, that Q4 miss isn't even what gives me the most heartburn.
Oh, you're looking at the liabilities.
Yes, the debt. They are sitting on total assets of about $141.29 billion. But to acquire those assets, they are carrying a staggering $68.3 billion in total debt.
It's a huge number, yeah.
It's massive. I mean, to me, Energy Transfer looks like a billionaire with this massive sprawling mansion, the $141 billion in assets, but who took out a $68 billion mortgage to pay for it.
That's a fun way to picture it.
Right. So with interest rates acting as this constant pressure cooker, is that Q4 earnings miss the first sign that they're, struggling to make those monthly mortgage payments?
I get it. It's really easy to look at a $68 billion number and just instantly hit the panic button.
Yeah.
That is a super common reaction, especially from retail investors. But if we connect this to the bigger picture and look at how infrastructure debt actually works, it tells a very different story.
How so?
Well, In the pipeline business, massive debt is a structural feature. It's not a bug. You're physically building steel assets that span entire continents. What actually matters isn't the total debt, but the leverage ratio.
Meaning, like, how much debt they have relative to the cash they actually bring in.
Precisely. So in 2020, their leverage ratio was up at 5.5 times. They were stretched pretty thin. But today, they've aggressively managed that down to 4.1. That is a drastic fundamental improvement in their financial health.
Okay, that's a fair point.
And to address your concern about them paying that, $68 billion mortgage, we have to look at a specific metric called distributable cash flow.
Which is what?
It's the actual cash left over after they've maintained their pipelines and paid the bills to run the business. For fiscal year 2025, their distributable cash flow was a very healthy $8.2 billion.
Oh, wow. So even after all the heavy lifting, they still have over $8 billion in pure liquidity just sitting there to service debt or pay dividends.
Right. They have more than enough cash flow to manage that debt load comfortably, even with a slight earnings miss in one single quarter.
Okay, so if the underlying cash flow is really that resilient, it makes me wonder, who is actually stepping up to buy the stock at this current 1885 level?
Right.
Are the people who know this company best running for the exits, or are they leaning in?
Oh, they are leaning in heavily, and it starts at the very top. Chairman Kelcy Warren has aggressively purchased over $100 million in units across multiple transactions in 2025 alone.
Wait, $100 million?
Yeah, and when the chairman is buying equity at that scale, it shifts the entire insider sentiment rating to firmly positive.
Here's where it gets really interesting to me. I always look at heavy insider buying like a chef eating every single night at their own restaurant. It's the ultimate vote of confidence, right? You don't eat the food if you know the kitchen is dirty. $100 million is a massive bet that the kitchen is spotless. And based on our sources, it seems like the professional analysts are, they're also grabbing a table.
They practically have the whole restaurant booked out. Honestly, out of the Wall Street analysts covering Energy Transfer right now, the consensus is overwhelmingly bullish. You have 18 buys, 3 holds, and exactly 0 sells.
Wait, not a single firm is recommending a sell?
0 sells.
On a company carrying a $68 billion in debt.
I know, it's rare. The average price target from these analysts sits at $22.07, which implies about a 17% upside from where we are today.
Okay.
And the highest targets go all the way up to $25. Even the lowest, most pessimistic target is $18.50, which is essentially just a floor right below its current trading price.
I hear the optimism, but I have to push back on this a bit.
Sure.
Analysts get things wrong all the time. Groupthink on Wall Street is a very real phenomenon. Once 3 major banks issue a buy rating, the rest often just follow suit so they don't look like outliers.
That's definitely true in some cases.
Right. And as for the chairman, insiders can be incredibly early. A billionaire might buy today because he sees a payoff 5 years down the road. But the stock could easily drop another 20% in the meantime, and everyday retail investors just get completely burned.
Yeah, that's a fair warning.
So what specific mechanism are these analysts actually seeing that justifies a $25 price target?
It's a vital point to raise, and caution is definitely warranted. But you don't get a 0 sell consensus purely on groupthink when a balance sheet has that much leverage.
Okay.
The analysts are eyeing very specific high-probability catalysts. The biggest one on the horizon is a potential credit rating upgrade to a BBB tier.
How does that actually change the math for the company?
Dramatically.
Yeah.
When you move up to a BBB rating, you cross a critical threshold into solid investment-grade territory.
Right?
Suddenly, massive institutional funds that are structurally forbidden from buying lower-tier debt can start buying your bonds. That lowers your cost of capital.
Ah.
When you're financing $68 billion, even a slight drop in the interest rate you pay saves you hundreds of millions of dollars.
And that capital just goes straight to the bottom line.
Exactly, instantly boosting profitability. Plus, they're looking at massive new infrastructure expansions in the Permian Basin, like the Hugh Brinson project, which locks in long-term cash flow for decades.
Okay, so the billionaire chairman is buying, the analysts in suits are updating their models with higher targets based on a credit upgrade. But, and here's the big but, we are still left with the reality of the market today. The stock chart looks painful. It's down over 4% in just 10 days. If everyone who understands the company loves it, why is it bleeding? Like, who is doing the selling?
To understand that, we have to translate the technical indicators into market psychology. Right now, the chart is showing a real clash. We are currently stuck in a weak, short-term downtrend pulling back, but it's happening within a larger, weak, long-term rising channel.
So it's taking a step down, but on an escalator that's generally moving up.
That's a perfect way to visualize it. And when we look at the momentum indicators, things like the relative strength index, it's neutral, sitting between 52.2 and 56.4.
Okay.
But the MACD, the moving average divergence, it's actually flashing a buy signal at 0.14.
Interesting.
Yeah, and the 200-day moving average is also a buy signal between $17.09 and $19. The real battleground right now is the 50-day moving average around 1873 to 1909. It's acting as both a buy signal and heavy overhead resistance.
So what does this all mean? How do we interpret this mixed bag of signals?
It means the aggressive selling that pushed the stock down 4% is starting to exhaust itself. The sellers are simply running out of steam as the stock approaches a critical technical floor.
What's that floor?
The key support floor is sitting right at $18.75. Above it, we have breakout targets at 1903 and 1921. But at 1875, institutional buyers have historically stepped in and refused to let it drop further.
So the stock is essentially a coiled spring right now, resting heavily right on that 1875 concrete floor.
Exactly.
But, I mean, what if that floor isn't concrete? What if it's glass? If that spring snaps and the floor breaks, doesn't all of that long-term analyst optimism just go completely out the window for this short-term trader?
It definitely would cause short-term pain. But this raises an important question, and it brings us to one of the most fascinating data points in the order flow. We need to look at the short sellers.
Okay, what are they doing?
Recently, short interest, the number of shares being actively bet against the stock, it actually plunged by 15.9%.
Really?
Yeah. Short interest is now just a tiny 0.9% of the total available float.
Wait, so the people getting against the stock are packing up and going home?
Exactly. We call that bearish capitulation. Think about it. When short sellers look at that 1875 floor, they realize it's just too strong. They took their profits from this recent drop and closed their positions. They don't believe the stock will drop significantly below that floor.
Setting up a clash between short-term weakness and long-term momentum.
You got it.
You know, that clash on the technical charts perfectly mirrors the central debate raging among investors right now. At 1885, are you buying a structurally undervalued asset, or are you stepping into a high-yield retail trap?
It's the ultimate debate for this stock.
Right. And let's dive into that. Let's start with the undervalued or bull case.
Okay. So the core of the bull argument rests on a relative metric called EV to EBITDA, enterprise value to EBITDA.
Which means what exactly for the everyday investor listening?
Enterprise value is essentially the price tag of the entire business, factoring in both the market cap and that massive debt load we talked about. By comparing that total price tag to the raw cash the business generates, you get a much clearer picture of value. Right now, Energy Transfer trades at a multiple of 10.15 times.
And what's the industry average?
The industry average is 11.5 times.
So compared to their competitors, they are undeniably sitting in the bargain bin.
They are. And if you run models based purely on their distributable cash flow, fair value is pegged somewhere between $23 and $27.69.
Wow, that suggests you are buying the stock at a steep 25 to 30% discount.
Exactly. And while you wait for the market to realize that value, they are paying you a hefty distribution yield of roughly 7.1%.
That's a massive yield.
It is. But what's fascinating here is that the math is only half the story. The real excitement from the bulls is about the physical infrastructure itself.
The pipelines.
Right? Over 120,000 miles of pipeline footprint. And that leads directly to the most powerful modern catalyst for the company. They recently signed game-changing agreements with Oracle to supply natural gas directly to their energy-hungry data centers.
Ah, the AI boom.
Yes. The reality of artificial intelligence is that it requires massive, reliable, 24/7 power.
And the current power grid is highly constrained. You can't just plug a massive AI data center into the local grid without causing brownouts.
Exactly.
I look at the renewable energy solution here, kind of like hitchhiking. Wind and solar are like standing on the side of the road with your thumb out. You might get a ride, but you can't guarantee exactly when or for how long.
That's a great analogy.
But these AI data centers cannot afford to be offline for even a second. Natural gas is the dedicated express train. It runs constantly, regardless of the weather. And Energy Transfer essentially owns the toll roads that the express train runs on.
They do. They are basically taking an old economy asset, gas pipelines, and making it an essential backbone for the new economy of AI and data centers.
I hear that AI narrative, and it sounds incredibly compelling, but I can't let the bear perspective go undefended here. Let's look at the value trap argument, because this is why retail traders often get crushed.
Let's hear.
You have retail investors getting lured in by that shiny 7.1% yield, but I look at buying ET for the yield, like buying a gorgeous classic car at a steep discount.
Okay.
It looks absolutely great sitting in your driveway. You get to brag to your neighbors about the dividend checks, but the constant expensive maintenance slowly bleeds you dry.
In the ET's case, what's the maintenance?
The debt and the lawsuits. That $68 billion debt load makes their cash flow highly sensitive to interest rate fluctuations. And furthermore, every single time they try to expand a pipeline, they face constant bruising legal and environmental regulatory hurdles for pipeline approval.
True. The regulatory environment is tough.
Every lawsuit is an expensive trip to the mechanic. You can literally see the wear and tear in their dividend growth targets. They're aiming for 3 to 5% growth, but currently they are lagging behind sector medians at just 3%. That classic car is rusting under the hood. And bears argue this is exactly why retail traders get trapped.
It's a very strong argument, and those downside risks and volatility are very real. But consider how the regulatory environment actually functions as a double-edged sword.
How so?
Yes, the environmental regulations and lawsuits are an incredible burden for growth. But that very same regulatory hostility is what creates Energy Transfer's impenetrable defensive moat.
What do you mean?
Think about it. You literally could not get the permits to legally build 120,000 miles of new pipeline today, even if you had unlimited funds. It's politically impossible.
Ah, right.
Therefore, the existing infrastructure they have represents a near impossible to replicate asset. No competitor could legally or financially replicate it today.
Okay, so we have all the pieces on the board. The massive revenue generation, the heavy yet managed debt load, the aggressive insider buying from the chairman, the short sellers capitulating at the 1875 floor. And this ultimate debate, an AI-powered pipeline monopoly versus an interest rate-sensitive value trap. So bring it all together for us. Based on our sources, what's the final bottom line?
Synthesizing the data, we really have to look at two distinct time frames.
Okay.
If you're focused on the short term, like the next 5 to 7 days, expect choppy performance. The models predict the stock will bounce in a range between negative 2.2% and positive 3.6% as it searches for a new bottom pivot near that 1875 support.
It has to prove to the market that the floor will actually hold.
Exactly. But if you zoom out to the structural long-term perspective, looking across 2025 and 2026, the long-term outlook eyes a 15 to 20% price appreciation, assuming they keep managing the debt and those Permian projects come online.
And everything we have discussed today, all of it, is going to come to a head very, very soon. Because the next major catalyst is the upcoming earnings report scheduled for May 5, 2026.
That earnings call will be huge. It's going to dictate the narrative for the rest of the year.
It really will be. Well, that wraps up our deep dive into the paradox of Energy Transfer LP. Remember, this was strictly a discussion of the sources, not financial advice.
Right.
But we want to leave you with a final thought to mull over. ET is sitting on an irreplaceable empire that is quietly powering the AI data center boom. But it carries a $68 billion anchor around its neck.
It's a heavy anchor.
When that May 5th earnings call rings, will it validate Chairman Kelcy Warren's $100 million bet? Or will the crushing weight of that debt finally shatter the 1875 floor and trap retail investors who are just chasing a 7% yield? Keep an eye on the charts, because something has to give.